So on March 23rd, the Fed announced they'll soon be breaking their own rules and boosting the stock market. Sounds crazy, right? In this video, I'll be explaining how they're breaking the rules, why they're doing so, and most importantly, how this affects you and me. If you're sat there thinking, I'm from Europe or the UK, and this doesn't affect me, unfortunately, the world's largest economy in the US has a heavy impact on us too. So let's get into it. With the majority of the US in some state of lockdown, companies simply aren't earning enough money. The government needs to find a way to get money into the hands of these businesses. In the past, they have printed money, and they've used this printed money to buy high-quality items from select businesses. In theory, this puts money into the hands of those businesses, and that feeds down into the economy. Yes, the Fed is printing money out of thin air, but at the very least, they are using it to buy high-quality items such as treasury bills. Imagine you had a friend come to you one day and say, I'm desperate for money. I need to borrow $25,000. Now imagine he's also not that good a friend because you don't want to loan him money for free. Instead, you want something back in return. So you say to him, okay, I'll give you $25,000, but in return, I want something steady. I want something that's going to hold its value. So I want you to go and get the deeds for your house, and I want 10% ownership. You give him $25,000, and he gives you 10% ownership of his house. He's happy because he has the money he needs, and you're happy because you own something which is somewhat stable in value. This is essentially quantitative easing or money printing of the past. Today, however, things are very different. The Fed is still printing money, but this time they are buying junk items from less reputable companies. So why are they doing this? Like I say, many businesses are struggling to earn money at the moment. Generally, when this comes about, they go to the market and they ask for a loan. A business might say, we need $100 million, we'll give you a 5% interest rate. And the market will often give them that loan so they can sustain their business. But right now, nobody wants to loan anyone any money. Everyone is holding on to their money so tightly in fear of what may happen over the coming 12 months. As a result, the Fed has announced something unprecedented. They will soon be lending money directly to companies. In fact, by the time you're watching this, this may have already begun. Worst of all, these aren't just regular loans. Many of these loans are described as junk. Junk meaning there is a very high risk that the company will never pay the Fed back. In fact, Moody's, one of the official rating agencies for these types of loans, have classified these types as speculative and subject to high credit risk. So now imagine your friend approaches you and says, I need $25,000. You turn around to him and say, okay, you can have the money. This time, don't worry. I don't want your house. I don't want anything anywhere near as stable as that. Instead, I'm quite happy to accept your vintage baseball cards. Not so stable anymore. Why are the Fed doing this? And what are the benefits we could see? Well, in theory, by giving cheap money to businesses, they could continue somewhat as normal. If that's the case, they could retain some of their employees, they don't have to make cuts, and that is going to boost the economy, plus just be good for the average everyday person. But there is something interesting to unpick here. Unlike other portions of relief for American businesses, this comes with no terms requiring businesses to maintain certain employment levels. There is also no limit to the dividends they can offer their shareholders, there's no limit to executive compensation, and no limit to share buybacks. As a result, there have been many critics highlighting that this may not help the average employee, it may simply help the shareholders and the stock price. So in other words, it may not help the economy, it may simply help the stock market. And since March 23rd, when this announcement was made, that's exactly what we've seen. The stock market is up significantly from that time, and yet the economy has suffered and unemployment levels have climbed. So what are some of the negatives which we could see as a result of the Fed loaning money to companies which may never pay them back? Firstly, this is breaking their own rules as part of the Federal Reserve Act of 1913. As part of that, they aren't allowed to loan money to any individual company. They're circumventing these laws by creating another company and then using this to loan to the stock market companies. So they're not directly giving money to the stock market companies, they're giving money to a company over here, and then this company loans money to those stock market companies. So as we can see, basically the same thing, just with one extra step in between. By loaning money to companies, the Fed is also taking on a lot of risk. Many of these loans simply won't be paid back in the future. So you might be thinking, how is the Fed going to get out of that? What if they loan money to someone and those people simply never pay them back? Well, bear in mind, these are the people who are in power of printing more money. So it seems like a likely solution to the problem if they find themselves short of money in the future, and you'll end up in a perpetual cycle of money printing. One of the other problems with loaning money to companies that don't necessarily deserve it is you could create something known as zombie companies. Capitalism is a very efficient way of forcing out wasteful companies. So if a company isn't efficient and they don't serve the likes of you and me, the customer, very well, then they will eventually die out over time. And that isn't a problem, because by dying out, they will make space in the market and a new, better business will emerge in their place, a business which serves you and me better. The problem is, by giving money to these companies, they won't be replaced by new companies that would serve the likes of you and me better. And that is ultimately fighting the core concept of what capitalism is. So how about you and me? How is this going to affect us? What's it going to do to the economy, and what's it going to do to the stock market? Well, the truth is, nobody really knows, because this truly is new. The Fed has printed money in the past, but they have never gone into the junk bond market and directly bought those bonds. After the announcement, the stock market had an incredible few weeks. So clearly, with the Fed stepping in and offering loans to businesses which may not otherwise be able to acquire those loans, it is going to be positive for the stock market. But at the same time, there are some negative forces happening too. So which forces are going to be more powerful? Well, with these things, I tend to analyze it myself, but also I turn it over to the smartest people much smarter than myself, and ask them, what do they think is going to happen? So let's look at what Warren Buffett has recently been saying. He said, we're doing things that we don't really know the ultimate outcome to. I think in general they're the right thing, but I don't think they're without consequences. And I think they could be of extreme consequences if pushed far enough. So he is saying that it might be the right thing, but also there could definitely be some downsides occurring here as well. And bear in mind that Warren Buffett is one of the biggest proponents of the American stock market that you'll ever find. For the past 60 years, he has been saying, buy an S&P 500 index fund and you get to buy a slice of the American pie. He said famously, never bet against America, and always bet on that upward trend that America seems to be on. But if we actually look at his actions, which I've done in a recent video, we can see that they are somewhat different to this. This is one of the first times ever that Berkshire Hathaway has been a net seller over the past 12 months. They're building up their cash reserves to levels they've never held in the past, and they aren't adding more stocks. At the same time, they've recently sold all of their airline shares and are clearly making indications with their actions, even if not their words, that they believe the stock market could potentially be headed on a downward trend. So yes, the Fed stepping into the stock market and saying you can have very cheap loans is going to be positive for the stock prices. We've seen that after the announcement. But Warren Buffett appears to believe, based on his actions at least, that the negative forces existing in the world at the moment may be more powerful than the positive stimulus that the Fed can apply to the stock market. Personally, I can see this both ways. My instincts are screaming at me that the stock market must crash, and much more so than it has already. We're seeing record levels of joblessness in the country, and I don't believe we're over the fundamentals of what has caused this in the first place. If we look at other countries, we can see that when they come out of lockdown, it appears the numbers begin to spike again very quickly. So there's no reason that the US should be any different. So all of this is working through my head and saying everything points to a stock market crash. There's nothing which seems to be supporting the argument the other way, except the Fed's intervention. The key question is, can the Fed intervene to a level which actually continues to prop up the stock market? If you look at the bond market, which is essentially the market for these loans that we were talking about earlier in the video, they're very thinly traded. And what I mean by that is there aren't many buyers and there aren't many sellers. If the Fed steps into this market, they can provide a lot of stimulus. But the question is, can they provide more of a positive than there currently already is a negative? This is the ultimate question, and one which nobody can confidently answer. If we look at the likes of Warren Buffett's actions, I think we gauge what one of the best investors in the world seems to think, and that is that the Fed isn't likely to continue to be able to push the stock market higher. If we look at the second biggest investor in the US, Ray Dalio, who runs the largest American hedge fund, he believes we're headed into a depression. So he is certainly even more pessimistic than Warren Buffett. If we analyze what these two guys are saying, it's clear they believe that the stock market is going to go down more so than it is likely to go up. Personally, I would tend to agree with this, but if you're watching this and wondering what to do with your money, ultimately no one can answer that question for you. You need to decide what to do with your own money by assessing the risk around you, by assessing your current situation in your life, and trying to be well diversified across many different assets and many different countries. So by that, I mean it might be an idea for many people to not just hold an index fund for one market. Only owning an S&P 500 index fund, that could be very risky. Whereas it may be a better idea to diversify across many different countries. So that might be buying an index fund across the UK, across Europe, across Asia, and many different continents. At the same time, diversifying across different assets and asset classes as well. So you can't ever time the market, but the best thing you can do is try to build a portfolio which is well diversified. So regardless of where the market moves, you get the best situation. If the market crashes, you don't crash as much because maybe you own a few market hedges. Ray Dalio, for example, has spoken a lot about gold in the past, and I would argue that Bitcoin also could be a market hedge by allocating just a small percentage of a portfolio to it. This video took a fair amount of research to put together, so if you have enjoyed it and taken something valuable from it, I'd really appreciate if you could simply hit the like button. Nothing else, just a single like. Thank you.